Welcome to the Sharpe Angle. I'm Leslie Picker. Emerging markets, specifically in Eastern Europe, have been whipsawed amid the war in Ukraine. Robert Konigsberger has been studying EM for more than 3 decades. He's the chief investment officer of Gramercy Funds, a $5.5 billion emerging market investment firm. Robert, welcome. Thank you very much for being here.
Good morning, and thank you for having me.
You've been buying Ukrainian bonds. How much do you own at this point? And can you explain your thinking behind this investment?
Sure. Well, let's start with the initial conditions. Fortunately, we own no Russia or no Ukraine coming into the invasion on the 24th. And quite frankly, the analytics were simple. We thought that, unfortunately, the probability of an invasion was pretty much a coin toss. And back then, Ukrainian bonds were trading at 80 cents. And Russian bonds were trading somewhere between 100 and 150. So we felt that maybe Ukraine had 10 points of upside in the fortunate occasion of no invasion, or maybe 50 or 60 of downside. Post the 24th, we saw bonds trade as low as perhaps low 20s, high teens. And so that gave us the ability to establish an initial position in Ukraine and quite frankly be very dynamic with that position, because we do expect that on the other side of this conflict, that yes, there will be a very strong and well-supported Ukraine by the West, but I would also hope and expect that bondholders will be sharing in the burden and in the recovery. And we've come up with this concept of a Ukrainian recovery bond that can help ease the bridge back to the financial markets for Ukraine eventually.
How much Ukrainian debt do you own at this point, and have you been building this position as you see the war unfold?
It's not a call on the war unfolding and what have you. It's a relatively small position. So as you know, we have multiple strategies on our platform. Some of them are long only emerging market debt strategies. So we tend to have a benchmark or market weight on the Ukraine at this level, where at 80 cents we didn't. And then some of our absolute return strategies, it's still a relatively small position, well under 5%.
What do you make of the school of thought, though, which says to avoid Ukrainian bonds because of the risk that Ukraine actually becomes part of Russia, which would, render that debt essentially worthless?
Well, there's certainly this notion, and let us hope that it doesn't become part of Russia. But we have a long history of countries that no longer exist, but their debt stocks remain. A couple come to mind. Yugoslavia way back when. Yugoslavia failed to exist, but its debt stock was picked up by the subsequent republics that came from that. And as long as we're talking about Russia, the Soviet Union ceased to exist, but its debt stock was still honored in a debt restructuring back in 99 and 2000. And even before Russia could issue bonds in 1996, they had to go back and restructure, actually repay some French franc bonds from the early 2000s. So our base case is that Ukraine will continue to exist. We don't think it will be absorbed by Russia. It will continue to have a debt stock. It will continue to have a vast portion of the assets and the debt service capability that it has today. Of course, it's going to take a lot of time for them to rebuild that. But I would not argue that the debt stock is worthless.
What about the debt stock in Russia right now? Have you been trying to trade that, whether on the long side or the short side? Do you have a position there?
No. So again, we're completely uninvolved in Russia. We have been uninvolved for months before the invasion. Once the invasion risk became something with substantial weight, just the risk reward, the asymmetry just didn't make sense. Post invasion, Russia 2022 is very different than Russia 1998, 99 after that default. A lot of the pain that Russia suffered back then wasn't necessarily all self-inflicted. A lot of the pain today is obviously self-inflicted. But let's think about it bottoms up and top down, why Russian debt doesn't make sense here. Bottoms up, we're still hearing from clients, this notion of self-imposed boycotts or sanctions. And I think it's still really early in the game technically in terms of the amount of supply that's going to be sold by ETFs and mutual funds and long only emerging market debt investors at a time when the pipes are broken. And what I mean by that is the banks are ceasing trading. The pipes, to settle it, the Euroclear, the DTC, what have you, are not settling. So even if you want to trade, it's going to become difficult. So quite frankly, I see a bit of a bottoms-up tsunami coming where there's inelastic supply that holders are told to stop holding this in a world where it's hard to get rid of holding it, which should mean lower prices. And then top down, what is Russia going to look like, quote, the day after? And I think one has to go back and look at how unstable Russia was in the period from when the wall fell in the early 90s until when Vladimir Putin consolidated power later that decade. It was very nerve-wracking having to understand who was going to consolidate power, what that was going to mean. And I remember, as an example, in the old days when Yeltsin was the president, I used to get calls from our trading desk, and they would say, Boris Yeltsin's in the hospital, and we'd have to triage why he was in the hospital, because one hospital was for sobering up, and the other one was the cardiac hospital. And if it was the cardiac hospital, we had to be really worried about what that meant for power on the other side of Yeltsin. And unfortunately, I think that's where we are today. I mean, many just say, the solution to Russia is that Putin's no longer there. But, with the end of Putin would become the beginning of what? And so I think top down, there's a lot of challenges about thinking about Russian debt as well.
What do you think is the likelihood at this point of a hard default by April 15th?
That's a great question. So default is usually about the ability and willingness for someone to pay. Certainly, in the case of Russia, they are indicating a willingness to pay, but a lack of capacity or capability. And that capability isn't necessarily because they don't have the financial resources. That ability is because technically it's going to be very difficult for them to pay. You can imagine a world where they try and pay a paying agent, and the paying agent, because of internal policies and external sanctions, what have you, make the decision to not forward that payment. It's not too dissimilar to Argentina when, way back when Christina Kirchner put, I think, nearly $1 billion in the Bank of New York. But since a court had said to Bank of New York, you can't forward that to bondholders, it became known as a technical default. So I think it's quite likely that you're going to see a default in Russia, whether they try and pay or not. And of course, there's all sorts of side conversations about whether they can pay in rubles or not, and certain instruments they can, but on the excess, the truly external debt, it's very clear they can't pay in rubles. So to the extent that they try and pay in rubles or have dollars trapped, we will have an event of default.
Do you think that this will be painful? It will choke the economy in Russia if it does go into a default? Or do you think they weren't really planning on accessing the foreign markets for debt anyway? Their debt load relative to other countries, their size is relatively small, only $20 billion in foreign currency debt at this point. So is it even that monumental for them from a sanctions standpoint?
To your point, I don't think the debt in isolation is that monumental. Russia is going to suffer deep economic consequences. The velocity of these sanctions and the depth of these sanctions is unprecedented. And just put debt stock aside, I don't really think whether they pay or not is going to make a difference as to whether Russia is an isolated economy, which is different than 1998, 99 when they had the default back then. The thought was, eventually Russia is going to want to reaccess the capital markets, that the debt default is the problem itself, and therefore they're going to have to resolve that very quickly in order to get access to the markets. And in fact, that's what happened. Within 12 to 13 months, they restructured the Venezia-Bank loans that then became Russian Federation bonds, and they were able to access the markets. Whether they pay or not this week, or whether they pay the April maturity, is not going to get them access to the markets, and it's not going to solve the dire economic consequences that economy is going to suffer.
What do you think are the broader implications for emerging markets? India, China, major trading partners for Russia. So one would presume that if their economy is suffering as a result of this, that it could have ripple effects to other emerging markets, obviously Europe and the US as well. But I'm specifically interested in places that are in that emerging markets bucket that you study.
Sure. I mean, similar to COVID, this is going to have different effects on different economies in emerging markets. And I think, one of the themes about emerging markets today is it's not this homogeneous asset class. It's not all risk on or risk off, but one has to kind of triage the impact of particular events or what have you that you may be looking at. So, in the case of COVID, we were talking about, which ones are going to be affected by the lack of tourism or whatever it may be. In the case of the Russia-Ukraine conflict, the impact on the oil market, I mean, immediately you could start to see winners and losers within emerging markets. And, EM is always considered to be a commodity asset class. Well, some places like Mexico are exporting oil. Some places like Turkey are importing energy. So it's hard to make a blanket statement in terms of what it's going to mean. That being said, I believe that the events of February 24th took the world by surprise. It was nobody's base case that there would be an invasion, and also an invasion of what I would call a capital I invasion. Maybe there was going to be an incursion towards the east of Ukraine, but this caught everyone by surprise. And therefore, the ripple effect is probably going to catch people by surprise. And I think, part of the challenge here is the cumulative effect, right? I mean, we have just, gone through a global pandemic, and now we're stapling right to that, war in Ukraine and the ripple effects of that.
Not to mention, there's already inflationary pressure, central banks hiking interest rates, which historically have had an impact on the emerging markets. So there are a lot of different layers to account for here as well. Going into, what you mentioned with regard to winners and losers, given the complicated macro backdrop, where do you see that playing out? Who are the winners and who are the losers?
Yeah, well, I mean, you start with oil, you start with commodities, you try and figure out which side a country or a corporation might be on that. One of the other things that may be less obvious is this notion that, and this is a blanket statement, which I don't generally like to make, but COVID and this crisis is going to be a bigger challenge for sovereigns in their balance sheets than perhaps it may be for corporates. So once thinking about the investment implications, sovereigns may be more challenged, corporates may be a safer place to be. Not unlike last year when we saw that high yield corporates in emerging markets outperformed the sovereigns. That was for a different reason because of the higher interest rates bringing lower prices. But imagine a sovereign that has a decision of, do we pass through prices to our society that can't afford these prices as it relates to food? Or do we subsidize that? And I think the choice is going to be they're going to subsidize to try and lessen the impact for their societies. Well, in doing so, not unlike we've seen with developed market balance sheets, that's going to put stress on those balance sheets that wasn't there before from a debt perspective, debt to GDP perspective, debt sustainability perspective. So that's certainly one of the things to look out for out here.
Fascinating. Robert, we really, really appreciate your perspective, your storied history in this space. You clearly have a lot of case studies to look at, but obviously we're in unprecedented territory. So we really appreciate your perspective. Thank you for joining us today.
My pleasure. Thank you.